mutual fund industry saw a strong finish to FY22. Net inflows into equity schemes surged to a record high in March 22. Investors poured in 28,252 crore in equity schemes in the last month of the fiscal, the highest ever inflow in equity funds. SIP flows too hit an all-time high of 12,328 crores in March. The annual flows through SIP continued to rise and almost tripled in last 5 years. SIP flows for FY22 stood at 1.24 lakh crore, a growth of 30% over FY21. Thanks to positive equity inflows in the past 30 months, the total AUM of MF industry increased to 37.5 trillion as of March 22 end, a 20% growth compared to March last year. AUM growth was also aided by rise in equity markets, which has resulted in mark-to-market gains. While FY22 turned out to be a spectacular year for MF industry in terms of equity inflows and growth, most listed asset management companies have underperformed the benchmark in the past year. This weak performance of AMC stocks is in contrast to favorable industry trends. One of the most widely cited risks for the MF industry is growing popularity of low-cost passive funds. Passive investment consists of investing through ETFs or index funds that track or mimic an index and is gaining attention as it has the advantages of low concentration risk, higher transparency and lower cost. The passive AUM in India has grown exponentially from 49,916 crores in FY17 to 5.21 lakh crore as of March end. While the share of passive assets has risen to 14% of the industry's total AUM, the bulk of existing passive AUM can be attributed to government initiatives, be it EPF allocations to ETF and the disinvestment program being mobilized via the ETF route. Retail investors contribute mere 3% of the total passive AUM. Inflows in actively managed equity funds far exceeded the flows in passive funds in FY22, despite the large number of NFOs in passive category and all the attention grabbed by the index mimicking funds. The belief that while the MF AUM is on an uptrend, the profitability of asset managers will be at risk due to rise in passive AUM and reducing fees holds true, but it may play out in the long term. So fully attributing the recent underperformance of AMC stocks to rise in passive investing will be too overstretched. In the past few years, MF industry has hogged the limelight for its exposure to the debt of troubled companies. It all started in September 2018 with default by IL&FS group companies. A total of 15 fund houses were invested in IL&FS and its group companies at the end of August 2018. Next, the industry was spooked when DHFL's commercial paper was sold at a discount by a mutual fund house. Another dent to the mutual fund industry came due to the exposure to the SL group. The list kept growing. Yes Bank, India Bulls Housing Finance, Reliance ADAG group companies. The final nail in the coffin was freezing of 6 credit risk schemes by Franklin Templeton. All these issues have been limited to debt mutual funds, and while it jolted investors' confidence, the inflows into equities has not been impacted for the mutual fund industry as a whole. That said, these events have tarnished the brand image of the fund houses that have been at the forefront of the crises. Such negative news flow keeps resurfacing time and again and could also be a reason for AMC stocks' underperformance. The dip in AMC stocks' valuation does not necessarily make them a good investment opportunity. While the industry trends are healthy, it's not going to be a rising tide lifts all boats kind of scenario. Investors need to be very cautious and invest selectively. HDFC AMC's asset growth has lagged the industry's asset growth in the past 1 year. Consequently, it has lost market share in terms of the overall AUM. No doubt, the stock massively underperformed Nifty and listed peers in the past 1 year. Even after correction, HDFC AMC is trading at rich valuations. While HDFC's premium valuation may sustain given ROE of around 30% and favourable asset mix with leading position in equity business, near-term upside to the stock price looks limited as HDFC AMC continues to lose market share. Nippon Life has corrected 30% from its 52-week high price. However, there has been some negative news flow related to the AMC's investment in Yes Bank's AT1 bonds. Investors better avoid the stock. Since its listing in first week of October, Aditya Birla AMC has seen a steep fall of more than 25% from the issue price of 712 rupees. While the valuation looks attractive, the AMC's equity assets growth lags the industry performance. Investors can keep the stock on their radar and accumulate only on further correction. Meanwhile, UTI AMC is the only listed AMC that has been gaining market share in equity assets. No doubt the stock has outperformed the listed peers. The stock has moved up by 51% after we suggested it as a best bet on improving domestic flows in May last year. We reiterated our positive stance by recommending UTI AMC as weekly tactical pick in February, and the stock has gained 9% even from there. Despite the outperformance, UTI AMC's valuation is attractive considering that ROE has improved from 10% in FY20 to 15% in FY21 and 19% in 9 months of FY22. Given the sector tailwinds and the improving market share, UTI AMC's valuation discount is likely to reduce, leading to re-rating of the stock. Overall, investors can look to play positive undercurrents in mutual fund industry by buying the stock of UTI AMC and can avoid the other 3 listed names.